let's begin. Morning, everybody. My name is Kristy FACCER, and I work for the Pacific Institute for Climate Solutions. And this is actually my second year attending this this workshop, and I'm really delighted to be here and to be back, and also to be chairing this session. So thank you to the co-chairs and organizers for allowing me to participate. And the session 5, as it's called, has the title of Climate Change Mitigation, Management Practices and Portfolio Choice, something that's very core to what we're interested in at PICS, at the Pacific Institute for Climate Solutions. And we have 3 papers: Do Firms Benefit from Carbon Risk Management? Evidence from Credit Default Swaps Market, Climate Change and Horizon Portfolio Choice, Combining Theory and Empirics. And the third paper is Outsourcing Climate Change. I think you all know the drill by now. We'll give 15 minutes for the presentations, 10 minutes for the discussant to respond to the paper, and 5 minutes for mostly Qs, but hopefully also some As. And if we get to 1 minute of the end of your presentation time, I'll try and interrupt. So excuse me in advance for that, to let you know that we're running out of time. And unless there's any questions or concerns, I will begin by handing over to Saurabh TRIVEDI from La Trobe University, who's going to present the first paper.
Thank you, Kristy. I will just share my screen.
Excellent. We can see it. Perfect. Over to you, Saurabh.
Hello, everyone. Thanks for joining the presentation. I would first like to thank the organizers to provide me an opportunity to present our paper. I'm a second-year PhD student at La Trobe Business School, and this is a joint work with Associate Professor Hu, Professor Petko, and Professor Madhu, who is also present in the conference. The title of the paper is Do Firms Benefit from Carbon Risk Management? Evidence from the CDS Market. Let us understand the carbon risk first. We know that global warming is at the forefront of regulatory and political agenda. The Paris Climate Agreement of 2015 started a race to become net zero economy. And the stated objective of the agreement is to reduce the carbon emissions to comply with 1.5 degrees Celsius goal by 2050. This chart actually gives an essence on how we need to think about this risk. Currently, we are emitting CO2 at a global level, which is around 50 gigaton of CO2 every year. And with the current policy commitment, it will reduce to only 47 gigaton of CO2 every year by 2030. However, to meet the 1.5 degrees Celsius goal of Paris Climate Agreement, it has to reduce to a level of 23 gigaton of CO2 every year beyond 2030. So we can understand that how difficult the problem is to tackle, and the current policies are not aligned to it. We need to understand that achieving this Paris target is going to generate risky pathways for players in financial market and for the companies. And this is known as the carbon transition risk. So what are the consequences of this carbon transition risk? Investors are being forced to decarbonize their portfolios by divesting away from carbon intensive firms. And governments are introducing punitive costs in the form of carbon taxes on businesses to reduce emissions. And thus corporates are under pressure to adopt policies to manage the impact of carbon transition risk. However, on the flip side, it has given an emergence of firms which are managing the risk relatively better. But how to assess a firm's carbon risk management? We use Sustainalytics ESG dataset to extract firm level score on carbon risk management practices. Carbon risk management score, denoted by CRMS in our paper, evaluates various firm level practices, policies, disclosures, and relative performance. It is a sum of scores on 13 indicators which are related to carbon risk management practices. A higher carbon risk management score value indicates a higher relative preparedness and performance of the firm to tackle the carbon transition risk. And CRMS can be used to compare management performance and preparedness of firms across sectors. So what are we doing in this paper? Given the setting that investors are increasingly concerned about the implications of climate transition risk on asset pricing, and companies are exposed to this climate transition risk. And we see that there are firms which are trying to manage this risk relatively better. We pose a research question to us that does carbon risk management performance impact credit risk assessment of the underlying firms? We study this through the lens of credit default swap market. And we find a statistically significant and negative relation between carbon risk management score of a firm and the CDS spread of the firm. Our results are economically significant. We find that one standard deviation increase in a firm's carbon risk management value decrease the 5-year CDS spread by 73 basis points. In terms of key contributions, ours is the first paper to consider the pricing of carbon risk management performance, especially into secondary credit market. It is the first paper to analyze implications of US state climate adaptation plans on firms' credit risk vis-a-vis their carbon risk management practices. But why should carbon risk management may be impacting the credit spreads of the firm? There are two theories which may explain the relation between carbon risk management and credit spread of the firm. First is based on the Merton model, which says that higher and less volatile cash flows translate into higher asset values of the firms, which results in lower credit spreads. From carbon risk perspective, we can relate to Merton's theory in 3 ways. Higher exposure to fossil energy use can lead to higher operational costs and volatility in the cash flows. And higher CO2 emissions can imply higher carbon taxes for firms, thus reducing their cash flows. And third, firms which are exposed to potentially stranded fossil fuel assets can reduce the recovery value of these assets. Another related theory is from the activist stakeholder theory, which says that environmentally responsible firms and socially ethical firms are rewarded financially in the long term. Hence, we test these theoretical predictions through the hypothesis that is carbon risk management performance is associated with lower CDS spreads. Our paper is related to burgeoning and topical literature of climate finance, and more specifically to climate transition risk theme. There is already a growing evidence that carbon transition risks are priced into asset valuations. For instance, Bolton and Kasperz's paper provide evidence of carbon premium demanded by the stock investors while investing into carbon intensive companies' stocks. Similarly, Nhan and others find that the cost of option protection against downside tail risk is larger for firms with more carbon intense business models. Similarly, Coble and others find that climate risk disclosures by firms in their 10K report filing impact CDS term structure. Our paper is also closely related to wider ESG literature, especially with the paper by Berth and others, where they find that firms with higher ESG risk show higher CDS spreads. However, none of these papers consider the impact of carbon risk management on CDS spreads. Coming to data, so our sample period is from August 2009 to May 2018. Our key variable is 5-year CDS spread of the US firm containing daily spreads of single name CDS contract. A firm level carbon risk management score is extracted from Sustainalytics ESG scores. We use several firm specific and non-firm specific common factors using more prior literature. Our final sample consists of 9,407 firm quarter observations of 405 different firms with CDS contracts. Here is a broad roadmap which we will use to explain the results of empirical findings. First, we provide baseline results using the panel regressions. Then we provide endogeneity tests using difference in differences analysis, where we exploit 2 exogenous climate-related shocks to allay the concern of endogeneity. And then we provide results on several robustness tests. So first we show our baseline regression results. The results show that there's a negative association between carbon risk management score of a firm and CDS spread of the firm. This is in line with our main hypothesis that the carbon risk management practices have risk mitigation effect on credit spread of the firms. Our results are also economically significant as we find a 1 standard deviation increase in the CRMS reduce the 5-year CDS spread by 73 basis points, which is 32% of the standard deviation of 5-year CDS spread. Coming to first endogeneity test, we use Paris Agreement of December 2015 as it is considered as the most significant event which increased the investors' awareness regarding climate change implication on investments. We use it as a quasi-natural experiment to address the concern of endogeneity by applying a difference in differences methodology. Here we use two model specifications to run our DID analysis. In model 1 and 2, our main DID estimator is CRMS into post. And for model 3 and 4, our main DID estimator is treat into post, where treat takes a value of 1 if a firm's CRMS is in the top quartile in the year 2014, that is 1 year before Paris Agreement. And as a result show that both these DID estimators have a significantly negative relation with the CDS spread, thus suggesting that Paris Agreement led CDS markets to view firms with higher carbon risk management performance more positively. Next, we use state climate adaptation plans of the states in the US as another exogenous shock similar to Paris Agreement to test for endogeneity. These are state government interventions, which include a mix of legislative actions, executive orders by governors, and soft appeal to all the stakeholders to tackle climate change. In our sample, 15 states in the US have passed the state climate adaptation plans. Here, the main DID estimator is CRMS into post escape, where post escape takes the value of 1 if a firm is headquartered in a state where state climate plans was implemented, and in the years post the implementation of state climate plans, else it takes a value of 0. Again, we find that our results have a significant, the DID estimator has a significant relation with the significant and negative relationship with the CDS spread at 5% P level. It suggests that state climate adaptation plan implementation led CDS market to view firms with high carbon risk management performance more positively as compared to firms headquartered in states without such plans. We run several robustness tests to provide evidence about the strength of CRMS and CDS relationship. To ensure that our carbon risk management score does not simply instrument other climate risk variables used in the prior studies, we provide a benchmark analysis. We compare our CRMS measure to the firm level climate risk exposure measures developed by Saurabh and others in their recent papers. The authors construct firm level exposure related to opportunity, physical, and regulatory shocks associated with climate change, using textual analytics to earnings conference call data. First, we take CRMS as the main dependent variable and the 3 main climate change exposure measure from Saurabh. And we find that opportunity climate change exposure measure has some significant relationship with our carbon risk management score. Then we rerun our baseline regression analysis and we add the opportunity climate change exposure from Saurabh as another control factor. And we find that even after controlling for opportunity climate change exposure measure, the CRMS CDS relationship holds. We also run several other robustness tests. First, we asked, is the relationship between CRMS and CDS spread driven by the governance? And we find that even after controlling for governance and also for social practices, the CRMS score have a bearing on firms' credit risk, but that relationship is more prominent only after 2015 Paris Agreement. Then we asked, does CRMS CDS relationship hold for longer term CDS contracts, such as 10-year or 30-year contracts? We find that relationship and the economic significance holds for longer term CDS contracts as well. Finally, we also asked, is carbon risk management effect coming from weakly managed firms or better managed firms? we find that there is a significant relationship between carbon risk management score and CDS spread among the weakly managed firms. The relationship becomes even more strong post the Paris Climate Agreement. Next, we conduct channel analysis. Firstly, we asked, is carbon risk management score related to any key firm level financial variables? And we find that CRMS is strongly related to firms with higher subsequent growth options, proxied by Tobin's Q, and liquidity reserves, that is cash reserves. Then we asked, is CRMS CDS relationship linked to key financial variables? And then we find that CRMS and CDS relationship is stronger for firms with higher leverage. And this relationship is stronger only after the Paris Climate Agreement.
Saurabh, one minute to conclude, please.
Yeah, sure, thank you. Now to conclude the presentation, so we started with the question that does carbon risk management of firm mitigate CDS spread? And we find that a firm having higher carbon risk management performance is associated with a lower CDS spread. And these practices have gained importance, especially after Paris Agreement. We also find that government interventions such as state climate plans can force investors to price the firm's carbon risk management judiciously while investing. There are implications of these findings for corporates and credit rating agencies. Corporates should implement carbon risk management practices to reduce their credit risk. And credit rating agencies can incorporate these carbon risk management parameters in their credit rating models. Thanks everyone for listening to the presentation. I'm looking forward for the discussion.
Excellent, thank you, Saurabh. So if you want to stop sharing your screen here, I'd like to invite Ines CHAIEB from the University of Geneva to discuss this paper. Welcome, Ines.
Hello, thank you for inviting me to discuss the paper. Let me just first try to find it here on my busy screen. Okay, it should be, here we go. All right, can you see it?
Yes, we can.
Perfect, okay. Okay, so let me quickly summarize the paper since Saurabh has done a great job presenting it. So I'll be very quick here, and then I will cover my essentially my 3 points listed here in this overview. So what the paper does, so the question here that the authors address is, does climate risk management reduce corporate CDS spread? And what are the potential channels through which the climate risk management has an effect on credit risk? And you see the colors here. This is really the 3 things that I will try to emphasize during my discussion. So the management of climate risk, reduce, so this endogeneity implied in this statement, and the channels. Now, how do they proceed? So they estimate climate risk management by aggregating 13 environment indicators from Sustainalytics and relate them to corporate CDS spreads. And the evidence is based on a sample of about 400 US firms over 2009 to 2018. And they find that firms with better CRMS, so carbon risk management, have lower CDS spread, especially after the Paris Climate Agreement. And the effect is quite sizable. Now, here actually, it helps us maybe a bit more if, of course, CRMS is not only about the firm's carbon emission, but if we try to translate this in terms of just, you know, how can you help the reader to read it also in terms of firm's carbon emission? If that's possible, I think that would be also interesting to size it up. They show also that the link between CDS spread and climate risk management is stronger for firms headquartered in states who have adopted the state carbon policy. And it seems to be the E in ESG rather than the social or the governance after the controlling for the social and governance variables. And on the channels, they show that the better carbon managed firms seem to show higher Tobin's Q and better liquidity reserves. Okay, so what are my readings of the key contribution of this work? So first of all, of course, I find it really interesting and well executed, and it enters this debate of whether financial markets price climate risk. Now, the focus here is on the corporate credit market. I couldn't find much of the link to Kolbe et al. And Barth et al., but I saw it here now in the presentation, so that's I think it's good, and I think these two papers deserve a bit more of discussion up front in the introduction, since they are very much related. The second contribution is which environmental information really matter for investors, since the authors will focus on these elements that help us, understand better the management of the climate risk. Okay. The third contribution is to understand whether creditors really reward firms who better manage. Again, the emphasis on management. Okay. And the fourth, maybe not that much emphasized here, and probably needs more careful treatment, is we also learn, of course, about the determinants of CDS spreads. Now, again, I would like to emphasize there is the measurement of climate risk, and measurement, of course, is always, when we measure this type of exposure is after hedging, so after management, okay? And the management side, okay? And the paper tries really to get to the management. Okay, so let me start with how we measure climate risk management. Okay, so this CRMS is an equally weighted sum of 13 individual scores. There's 13 individual scores that the authors judge as, they capture management of climate risk. Okay. So I think, would be useful to understand a bit more on which dimension firms vary the most. Is it really from the efficiency innovation that are really, related to management? Or is it the disclosure side, which is, of course, very important for pricing? This is how, investors will price climate risk. But I think it's important to understand here, how each of these different elements that are, part of this individual score, that's 13 individual scores, how they differ across firms. And it seems to me there's a lot of, measurement that capture disclosure. Okay. And as far as I understand, these are equally weighted. So maybe you would like to play around a bit with the weighting scheme to say, to see to what extent, it affects your finding. The next point is about the use of only this source, which is, of course, it's used in alternative, the studies, but we know that there is a large disagreement among data providers. This point also has been raised yesterday during the discussion by Sadok, and I know also some of the work, since I have my colleagues at the University of Geneva working also on this, Gibson, Kruger, and Schmid. They have provided evidence on this, Berg et al., and other papers that have been cited yesterday. So we know there's a lot of disagreement. So of course, this might lead us to ask, to what extent the results are robust, the use of this measure or this source. Okay. And then the next point about the measurement, so there's high persistence, and endogeneity, of course, is a serious issue here that the authors tried really to address as much as they could. But I will come back to this. Clearly, if you lack this variable, it's not going to help alleviate endogeneity. Okay. Now, one more thing about this measurement of climate risk and climate risk management versus climate risk exposure. So of course, would be interesting to see how effective is the management. Do we see firms who are managing better their climate risk, manage to have a lower carbon emission? Of course, it takes time, but if we could have, some evidence on that, I think this would be interesting. Then when I see this low correlation with Sotner et al., this paper uses earnings or textual analysis of earning conference calls and provided this or construct this new measure of climate risk exposure. And then we see that the correlation with transition risk is pretty small. And actually the correlation is higher with opportunity risk exposure. And then the authors do this univariate portfolio sorts, and here, no surprise, firms with higher climate opportunity risk exposure are the ones who are also the firms who manage climate risk, and the ones with higher climate risk exposure and lower CDS spread. So here I started, I'm thinking maybe a double sorting would be more useful. Okay, so maybe you would want actually to see within the firms with similar climate exposure, do we see that the firms with higher climate risk management have a lower CDS spread, okay? Which I think, we could also, it seems, there is some evidence from this interaction effect that does not seem to be significant, which also was a bit surprising to me. At least I did not expect to see this result. Now on endogeneity. Of course, this is, usual difficult thing to deal with, the reverse causality and omitted variables. Okay, so the one thing that I have already mentioned, this high persistence of the climate risk management measure. So maybe you want to run the analysis instead of level with spread. Okay. The other thing, maybe you would like also to look a bit more into the cross-section versus time series variation, the CDS spreads, and see, how much is explained by the climate risk management. It's kind of a variance decomposition. The other thing that puzzled me here is that I don't see any control for the CDS contract itself. Okay, and there are many studies that have shown that the liquidity risk is quite significant. Okay, although these are highly liquid.
I'm just going to wrap up in about a minute or less. Thanks.
Sure. Okay. The other thing is there is a positive correlation between credit spreads and the fix. So maybe you want to control for the fix. Now, on the diff and diff approach, so you have this Paris Climate Agreement. Would be also interesting to look at what happened, after the President Trump's 2017 announcement of the U.S. withdrawal from the Paris Agreement. Would be also interesting to run the analysis for high yield versus investment grade firms. And back also now to what is specific about, the CDS market. Not only we have this price, the Paris Climate Agreement, but also we have something very important that happened, for the CDS market. In particular, so in December 2015, we have, they changed the standard roll frequency that increased the liquidity. So it would be interesting to see, how this affected differently the CDS spreads. Okay, and then on the channels, and then I will conclude. So we've seen this discussion also coming through this PhD session, and also yesterday about, what's going on here? Do firms with high leverage underinvest? So we have this debt overhang issue, or is it an overinvestment in CSR for reputation and so on? So I think it would be interesting to push a little bit the discussion here, and if possible, the analysis. And we've seen very nice papers already discussed earlier. Who are the holders of the single name CDS contracts? The PEG issue, are US banks and other investors reallocating credit away from polluting firms? And we have some evidence that it seems to be the case for European, but not really US banks. And to what extent credit ratings agencies are really responding to climate ESG scandals. Okay, so I will just conclude to say this is a very interesting paper that contributes to the debate of whether financial markets price climate risk and which environmental information really matter for investors. My wishing list may be a bit more of robustness on the measures of climate risk management. Endogeneity is dealt with, but maybe a bit more of experiments here could help, and essentially extend the discussion and the analysis of the different channels.
Excellent, thank you. Thank you to both our discussant and our speakers. I'm going to suggest we move on to the next paper, though Michael, I do see you have a question, and would invite you to put that question in the chat for our authors. Thank you very much. And I would now like to invite Xander Hutt to share his screen. Xander's from Erasmus University. Welcome.
Yes, thank you very much. Oh, this. So I was planning to type Control L, but I did Start L, so I locked my screen instead. So here I am. Sorry about that. So thank you for the opportunity to present here today. Let me just get a timer in front of myself so that I know what I'm doing. All right, so my name is Xander Hut, as said before. I'm a PhD candidate at Erasmus University. This is my first paper written together with my promoters, Mathijs, COSEMANS, and Mathijs van Dijk. So this first paper is about climate change and the impact on long horizon portfolio choice. And we look explicitly at this long horizon because we care, or at least we focus a bit more on the uncertainties that we get in this long horizon, especially. And we will combine some theoretical results with empirical data to come to a conclusion for portfolio choice here. So I'll go a bit deeper in that in a second. So first of all, this uncertainty over the longer horizon. What am I talking about here? So let's start off with a quote from Robert Stembaugh. It's in the New York Times a while ago. And it said, expand the horizon to the next several decades, and the possible effects of global warming range from negligible to catastrophic. So I think this really highlights that at the long term, we simply don't really know what will happen to the climate yet, and also not really what will happen in terms of financial markets related to climate change. So there are several uncertainties here, and our main focus in this paper is the uncertainty about how climate change affects asset prices. And we have a few issues there if we just want to focus on the historical data that we have and we make forecasts from there. So for example, if we want to make long horizon forecasts, we tend to want to use a long sample for that. But we only have a relatively short sample in which people actually start caring about climate change, and it could potentially be priced. And in this short sample, we also have some issues with, for example, increased demand for ESG related investments, which is nice in itself, but may distort some of the long-term extrapolations. So at the same time, if we look at climate change nowadays, then the disasters that we currently have in our data will not really be representative for what we would expect in the future if climate change would continue to go worse and worse. And there are additional issues with uncertainties in estimation of the parameters you're using, etc. So we wish to tackle these issues. And for this, we use an approach that was first implemented by Afromov and co-authors on another topic. But I want to highlight the quote that they have in their paper to kind of motivate what we are doing as well. So they say asset pricing theory could provide additional guidance about important aspects of the return process for which sample evidence is not particularly informative. So we argue that this is exactly the case of climate change, right? So for these long horizon forecasts, we don't feel that our sample evidence is informative. So we want to add theoretical guidance to our estimations. And we do so by adjusting our general factor autoregression model that we use for return regressions by Bayesian theoretical prior beliefs. So we include beliefs about the parameters in this FAR model, and those beliefs have something to do with how climate change should affect asset pricing. And we take those from the temperature long run risk model that Bansal and co-authors wrote. And in this way, we can include some things about physical risk for long-term climate change. And I focus here on physical because this model from Bansal and co-authors is really based on these physical disasters that happen in the model. So we are not able to include any transition ideas there. Okay, so where does this fit in the literature? Well, we essentially have two streams here. First, of course, is this growing climate change literature. And I think I can be relatively short about this because most of you are familiar with this. But overall, there's a lot of evidence and more evidence coming that climate change has some impact on stock returns, profitability, that there's more uncertainty, that several different climate change measures have impact on investments and etc. And then the second literature group that we're working towards is this long horizon risk and portfolio choice literature. And perhaps some of you are less familiar with that, so I'll focus a bit more on this. the idea here is that if you invest for the long term, there are a few differences with the short-term investment. And key differences are, for example, that if you start by investing more periods after each other, then a current low return may be offset by a future higher return. And if this happens to be the case on average, then we call this mean reversion, then investing for the long run should be less risky than it is for the short run, in equities at least. And these are the type of ideas that we are working on, and we are thinking about how climate change affects those things. So in a nutshell, let's go back to the methodology. We have a factor autoregression in which we forecast market returns and returns of risk-free assets. And we use those, to forecast these, we use general predictors like the price-dividend ratio, but we also include the temperature anomaly to proxy for climate risk. And we make forecasts from these from this model to get future returns that we use to optimize portfolios from. As I said before, we use a Bayesian investor. So we have beliefs that come from this theoretical model about climate change, and I will go into that a bit more in a second. And then we apply this to two settings. First, when we have an investor that optimizes portfolios between the market portfolio and the risk-free asset. And then we also look at portfolios that are vulnerable or non-vulnerable to climate change and how you should divide your investments about those two. So let's go to this model. So without any formulas, the model idea is that there's long-term risk from climate change. And this follows roughly the following channel. So climate change impacts the number of disasters that we get in the future, which are essentially based on the temperature level that we get in the model. And these climate-induced disasters, then they affect economic growth. And economic growth has this impact on financial markets. So that's how we get prices changed because of this long-term risk in this model. We use this model to form a Bayesian estimation and as a benchmark to compare what would happen if we use a similar prior model, but without any climate change. We also have a benchmark based on the normal long-run risk model by Bansal and Yaron. And in that model, essentially, you also have persistent shocks that are now climate disasters in this temperature long risk model. But it's slightly different, and we'll see how the difference works out in the end. So let's just look at the calibration. So this is the quarterly data that we get. So these are the quarterly returns in the data and what we find in the long run risk and temperature long run risk model. To be relatively short, I think we can match many of the things that the normal long run risk model matches well. Also relatively well with the temperature long run risk model. There's general issues with the price dividend ratio that is too low in long run risk models, but this is the case not in specifically in our temperature long run risk model, but in general long run risk models as well. And then there's one thing specifically that we now start matching in this temperature long run risk models, which is the temperature level itself. So this is the temperature anomaly. And here we match the volatility and the temperature anomaly relatively well, but our calibration kind of fails to match the temperature level. So I want to highlight that here as well. We argue that this shouldn't really matter for the long-term forecast because there we use the same future forecast for temperatures for both the model and the data. But essentially this is because the temperature long run risk model has a concave forecast for temperatures. So temperatures increase a lot in the beginning and then increase less fast. So then the average temperature is relatively high. And in the data, we actually see the opposite. So that's why the average temperature level is a bit lower.
It's 1.5 minutes there, Xander.
Oh, okay. So that's faster than I expected. Well, then let me just... sorry, is it really like I thought we had 6 minutes left? I mean, just to know how quickly I have to conclude.
Yes, that's right. I'm sorry.
Oh, okay. Sorry, I was kind of stressed here. Okay. All right. So let's look at the model. So what do we get? So this is the factor autoregression where we have market returns and risk-free returns, and we forecast those based on our predictors. And I want to highlight this last column, which is the temperature anomaly. So essentially what we find is that there are completely opposite ideas in the data and our model, which is also why we use this Bayesian setting, right? So this is actually a nice feature in our setting. It looks pretty small, but this is actually really large as well. So it's not significant. So it's all kind of noisy, these estimates, but they are economically very meaningful. So this 0.009 implies that if we have a temperature anomaly of 2 degrees Celsius, then actually we have 1.8 percentage of quarterly market returns higher. So that's a huge impact on these market returns. And the difference with this temperature long risk prior is quite strong as well. So what does this imply if we make forecasts from these models? First, I want to look at the variances that we get, and then I will look at the returns and the portfolio optimization in the end. So first of all, if we look at the variance that the model implies, we get really high long-term variance compared to short-term variance. And this is driven by the fact that there's a lot of uncertainty in the parameter estimates and in the temperature levels that we forecast. So if you keep your equities for a long time, you get a lot of risk in there. In the data, this is the opposite, and this is mainly because in the data we saw a lot of mean reversion that I talked about before. So these are quite opposite results. In the data, you find that longer investments are less risky, and in the model, it's the opposite way. And then combined in this Bayesian setting, this temperature long risk model implies that long-term equities get riskier than short-term equities. And actually the normal long risk model, which is the green line here, also shows the opposite. So this kind of shows that there's really this climate change inclusion really affects the amount of risk that you get in the long run. In terms of returns, let me be a bit quicker here in the interest of timing. We find that if we just look at the blue line, which is the temperature long risk Bayesian setting, returns are relatively high in the beginning, but lower than the longer risk benchmark towards the end of our forecast period. So essentially, we get higher returns in the beginning because there's more risk in the system, this climate risk that we add. But in the long run, we actually get lower returns because there's also disasters that start hitting in our simulations of the model. And these start impacting returns. So what do we get if we combine this into an asset allocation? Well, if we look at the amount of money that we should put in the market, we find that in the short run, there isn't too much difference between the different settings. But if we just focus on the Bayesian settings, so the blue line for the temperature long risk prior and the green line for the normal longer risk model, we find that these higher returns in the short run imply that you should invest a bit more in the market. But in the long run, the amount of risk that we get from investing in the market when we account for this climate risk results in lower allocations to the market. And this effect is economically meaningful. This is almost a third less in the equities if you look at 25 years period. All right, so I just want to go over this in 2 minutes. So let me skip the regressions here, but just look at the allocations that we find for the if we look at vulnerable and non-vulnerable portfolios. So these are, well, generally thought of as green and brown, but we keep them as vulnerable and non-vulnerable in this case. And then I want to look at what differences you get if you look at either the data or again our model. So in the data, we find that relatively high returns were found for the non-vulnerable assets. So we tend to invest a lot in these non-vulnerable assets compared to the vulnerable portfolio. And in the long run, we start investing more in this vulnerable portfolio because correlation decreases between the two. So we get diversification benefits. And actually, we find the complete opposite in the model. So in the model, these vulnerable assets, they have more risk and this is fairly priced. So you get higher returns. So you start investing a lot in these vulnerable assets. So here, it really shows that what your beliefs are, it has a lot of impact on what your optimal portfolios will be and if you should invest in vulnerable or in non-vulnerable assets. So just to conclude on the final slide, we think that especially uncertainty about climate risk is particularly relevant for long horizon investors. But we don't have enough data to make serious forecasts about this with the historical data alone. So we include a temperature long risk model to predict more specific results there. And we find that we get higher but riskier long run risk premia for this model. So then we invest more in the short term to equities, to risky assets, but less in the long run. And if we look at vulnerable and non-vulnerable assets, we find that the data favors non-vulnerable assets because of high recent returns. But if vulnerable returns would be fairly priced, they should have higher returns as well. So we find the opposite effect in the model. All right, thank you very much.
Thank you, Xander, and apologies for that. I'm now setting my timer for 15 minutes for the speaker and 10 minutes for the discussant. So without further ado, let me invite Kevin Andrew to discuss this paper.
Thanks, Kristy, and thanks so much, Xander. I just want to check that everyone can see my slides, as I'm not currently seeing them.
No,
we are not as well.
Okay, share content.
We were seeing a gray screen earlier.
Yeah, that's what I'm seeing as well. Okay. Okay, one sec. Sorry, I don't know what to do here, and I don't want to waste too much time. So I'm just going to start my discussion without slides. Okay, I have them in front of me. I apologize for this. Anyways, thank you, Xander, for that lovely presentation. So here is my, actually, you know what we could do? Kristy, can we take a question from the audience while I re-log into Zoom, and then I can give a shortened version of my discussion? Would that
yes,
work?
Fine. And why don't you also send me a copy of the presentation so I can share if needed.
Okay, yeah, thank you.
So let's flip over to any questions from the audience. Vikas.
So again, very interesting work. I was wondering if you have followed something called the Dismal Theorem. It came out of Mr. Weitzman at Harvard, and he talks about very long-term assets, in particular, very long-term returns associated with things like climate change, which have catastrophic effects on consumption. So the question then becomes, how do we discount those returns?
Yeah, so to be honest, I'm not aware of this theorem. I do have some results on discounting for this long term. So actually what we find in the paper is that if we account for rollover risk in the risk-free asset and in other bond portfolios, we actually see that climate risk really affects the risk also in those assets, and that implies actually that our discount rates get affected quite a lot by the uncertainty in climate change as well. But to be honest, I wouldn't be able to relate this to the theorem you're referring to.
That's fair. It's very interesting that there's some recent work by Martin I'll send you that reference too. But anyway, let's go back to Kevin. Thank you.
All right, thanks.
Looks good, Kevin.
Okay, thank you very much. Okay, so thank you. So thanks again, Xander, for the opportunity to discuss this paper. It was a very interesting paper. The first thing I want to do is to summarize what the paper does. So first of all, the paper is essentially a forecasting exercise. In particular, the authors forecast the risk-free rate, market return, and equity premium at quarterly frequency for the next 25 years. So those were the outputs that I was most interested in the model, as well as the portfolio weights that were presented today. In additional exercises, the authors construct portfolios that are vulnerable versus non-vulnerable to climate change, and they forecast the returns on these as well, and also solve an additional portfolio allocation problem where we can look at the portfolio weights assigned to these different portfolios. So there's a lot of other things going on. There's methodological contributions, but in terms of what the paper presented that I found really interesting, these are the three things that I thought were the most interesting. Xander shared these figures, so I'm not going to dwell on them very long, but the kind of headline figures to me were, one, looking at the risk premium, which is in the bottom left panel here, and the different colors show different priors that they use, so different underlying model information. And as you can see, the risk premium is increasing in all these cases, but For the case that we're most interested in, the LRRT Bayesian case, the risk premium is increasing and higher than a data-only approach. So including prior information about future climate change will increase the forecasted risk premium at all horizons. And the effects on the portfolio allocation problem are shown in the next figure, which was also presented by Xander. And as you can see, compared to a data-only exercise, adding this information about climate change shifts down significantly the weight that you would put on equities at pretty much every horizon and basically removes this hump shape pattern. And that has to do with mean reversion, as Xander talked about. So the methodological contribution of this paper is essentially to combine the methodology from Avramov et al. With a theoretical framework from Bansal et al. Working paper 2019. So the Avramov et al. Paper looks at the long run risks literature without a climate change focus. So the methodology is very close to that paper. And then the theoretical framework is taken from this more recent literature, which hasn't even been published yet, from Bansal, Kiku, and Ochoa. And they use a Bayesian vector autoregression. And I was happy that Xander really clarified that this is a paper about physical climate risk, because I noticed that wasn't emphasized as much in the paper and probably should be. And they look at the effects of physical risks on future risk-free rates, equity returns, and risk premiums, conditional on one climate scenario, which is a 2-degree scenario. So I'm just kind of narrowing the scope of exactly what the exercise is, but it's still a very interesting exercise. And the idea is to combine the past data with an underlying economic model. And the different models are the long run risk temperature model, the basic long run risk model of Bansal and Yaron, as well as a diffuse prior, which just lets the data speak. So it's just like running any old vector autoregression kind of. And then a Bayesian prior, which basically takes a weighted average of the long run risk temperature model with the diffuse prior. So my assessment of the paper, the strengths are very strong technical skills on display. There's a lot of simulation. Basically, nothing has a closed form solution. And so a lot of work went into this paper. It's a novel and appropriate methodology applied to a very important problem, which is a very good place to be. So forecasting the effects of future climate change is a very difficult thing to do. It's very uncertain. And it's a natural for the Bayesian paradigm, in my opinion. So it's the absolute right type of methodology to use for this problem. Areas for improvement. I think you guys are in the middle of writing your next draft. So most of my areas for improvement are about how to frame the results in quantitative terms. I noticed a couple times in the presentation, you mentioned the economic significance of the results. I would like to see more of that in the paper because it was hard to translate the figures and tables into what does this mean for the risk premium, et cetera, et cetera. So what are the headline figures? So in the abstract, what's a few figures in terms of numbers that will be meaningful? So the portfolio weight figures, for example, would be one way to go, as those are pretty striking, and they have direct meaning to practitioners as well as to academics. Or are your results just directional? X increases Y. Right? Sometimes the results are that way, but if they have a quantitative meaning, emphasize that more. So I have a bunch of constructive comments. If I don't get to them all, that's okay. I'm going to share the slides with Xander. My first is on the calibration procedure. So the prior model, the long run temperature risks model, I noticed the equity premium in all the figures is no higher ever than 1.75%. My understanding is the long run risk literature, the idea was to match the equity premium. And I just wondered why that wasn't in the calibration procedure of the prior models. You match the moments you target very well. It's just something, if you're going to focus a lot of the results on the equity premium, it would be nice to see targeting a realistic equity premium that matches the data. And I think it actually might be possible with the model you're using. Okay. The temperature scenario, as I kind of hinted at, it's great to use a deterministic path for temperature to kind of isolate other types of uncertainty. However, we now know from the latest IPCC report that the 2-degree path is actually quite optimistic. It might be really nice to look at a 4-degree scenario. It also would be really nice to look at a disorderly versus orderly transition. These are the sorts of things that are of a lot of interest to institutional investors who would be interested in your type of work at this type of horizon. So that's something you could, I think, easily add to the analysis that would be really interesting, or it could be a follow-up paper. The framing of the paper, the way the abstract and the introduction are written, you discuss your novel approach before you discuss your research questions and results. So I would encourage the flipping of that for the next draft, because, you know, I think it reads like it started from a novel contribution in terms of methodology and in search of a problem. And I would like it to read more of a research question in search of a methodology. Lastly, robustness to the sample period. The sample period is 1947 to present. And I would just be interested to know how your results change when looking at maybe only, you know, 2000 to present, 1990 to present, because, you know, climate change hasn't been salient for very long. So that might impact your results of the, you know, relationship between temperature on returns, et cetera. And lastly, for the analysis that you briefly showed at the end, where you're looking at vulnerable versus non-vulnerable portfolios, it would be nice to see more information in the paper about how you classify these stocks. So apparently you do a regression of returns on temperature. It would be nice to see the table of that regression in the paper. And it would be also nice to see some robustness around this, because it's basically a paragraph in the paper. And I wasn't sure if this is an accepted methodology for doing this or not. It was very hard for me to figure out, you know, what the strengths and weaknesses were of this approach. And I think it's very interesting, that part of the analysis. So it would be good to just make that a little more transparent to the reader. So thank you very much. Sorry for the technical difficulties. I think we made it through though. Thank you.
We sure did. And not only that, but we have a moment for an additional question. And if not, a response from Xander.
All right, so let me give a brief response. So thank you very much for the comments. They're very valuable, I think. Yeah, so we actually had, I was mostly laughing about your 4 degrees scenario. We had this before, but then we got some comments that this 4 degrees was too extreme and we shouldn't be doing that. But yeah, so I think most of them I fully agree with. I think we're especially the writing, it's something we're currently in the process of doing, so that's correct indeed. There are some issues with some comments that you make that technically just make it very hard to do. So for example, the shorter sample, I agree that this is kind of like, would be very nice, but then we kind of have this issue that if you want to make a very long-term forecast, then you actually need a lot of data. And if we compare our paper to other papers in this long-term literature, then we actually already have like a really short sample because we want to make sure that we don't take off our results from like 1870. But yeah, so it's those are kind of different things, difficult things to balance. And this is kind of the benchmark we found, but we could definitely add some robustness there. I think this vulnerable, non-vulnerable approach, that is, so we could definitely describe it better, but it is kind of like, there are several other papers doing something similar. So I think this is probably the way that it's being done, at least for so far that I've read it. But thank you very much for the comments, and I would definitely like to have the slides to recap them order to my notes.
Great.
Thank you.
Thank you both. Thanks, Kevin. Thanks, Xander. And I'm going to save the last 2 moments or 2 minutes in hopes that we'll spare some time for some additional questions for the first presenter at the end. I'd now like to invite Lillian Ng from York University, who will be presenting Outsourcing Climate Change.
All right. Thank you so much. I'd like to thank the organizers as well as Nora for her willingness to discuss this paper. This is a paper on outsourcing climate change, co-written with Dijk, Edwards, Rituan, who presented her paper yesterday, and Howlin at SMU. So let me start off with this map, and I got this map from New York Times when I was reading it last week. It shows the extreme weathers are a hallmark of climate change. If you look at the United States, it looks like there are 2 Americas, one very wet and on the right, and one very dry on the left. And
Lillian,
this has
we can't see your screen.
Sorry?
We can't see your screen.
Oh, sorry, I thought we could. Let's see.
Unless that's a problem with my machine. Can other people see the screen?
No, I cannot see it, Kristy.
Okay. All right, let's see. This is better.
Yep, see it now, but not in
Okay,
presentation.
okay, can you see it now?
I can see it.
Okay, thank you. So this
Could
is the
you
map
just
that we,
expand the size of the,
sorry.
could you expand the size of the screen?
This is on the, it is on the
Largest, okay.
view mode, I mean. All right, so this is the map I just talked about. We have the, on the right, the east side of the US is very soaked, and on the west is parched. And this has been the weather for the last 20 years, where America, the lower side has become drier and the left side has become wetter. And you have witnessed, have heard the news of Hurricane Ida on the US Gulf Coast is affecting millions of households without electricity. So this is what we are concerned about, the climate change. All right, so what I'm looking at is I took the 10 most polluting countries in 2019. This is a report just put out not long ago. The world itself in 2019, the global carbon emissions have reached 34.1 billion tons of carbon dioxide in the atmosphere, of which the US is the second largest contributor to the emissions, and China being the first. If I were to look at one simple example using, in the paper we talk about scope 1, scope 2, and scope 3 emissions. Let's look at GHG's protocol, where they categorize a company's greenhouse gas footprint into 3 different scopes. Scope 1 is generally the firm's direct emissions owned and controlled by the company. Scope 2 will be the electricity purchased for the production. And scope 3, there will be 2 types, the downstream, which is mainly capture the emissions that were created by the end users. And the upstreams will be the ones from the supply chains that produce inputs and products for the firm. So with this, let me see why I'm not moving. Okay, so for the institutional investors, we are looking at is the survey that was done.
And I think we're not advancing these slides. So let's see. If
You can see the slides advancing.
The one that we see is GHG footprint scopes 1, 2, and 3.
Oh, okay. You can. I am sharing. Let me see. Resume share. Let's see whether this works. Does it work now?
We're still seeing this GHG footprint scopes 1, 2, and 3 slide, and then we also see your bookmarks.
Okay, let me just go redo it.
Yeah.
Is this better?
Much better. Much better.
I just moved the cursor. Okay. So in the paper, what we have done is we use the Procter & Gamble example to show what it means for firm when they want to tackle climate change. As we know that P&Gs produce toilet rolls, they have to cut trees, and ultimately it's the toilet rolls, toilet papers that we use in our homes. P&G is committed to reduce their annual emissions by 50% by 2030. However, if you look at P&Gs, they are looking at 4.3 million tons of emissions. So the reducing it will be like 50%, we're looking at 2.1%. But if you were to factor in the scope 3 emissions, i.e. the supply chains that produce the emissions to provide the final product for P&G, you're looking at 250 million tons. So here we have a pie chart here showing that what P&G has committed is only scope 1 and 2. By 50%, the amount of emission reduced by 2030 will be very negligible compared to the amount of scope 3 emissions that the company produce. So if I were to look at so what we have done is we look at the emission produced by US firms, the direct proportions, as well as the supply-induced emissions in the total amount of emissions produced by US firms. On average, you can see that this orange line is the scope 3, that means the proportion of scope 3 emissions in a US firm on average has been going up. And if you look at the direct emission, it has been going down. So implicitly, it shows that US firms indeed reduce their emissions, but they're only reducing the scope 1 and 2, but not scope 3. So scope 3 has contributed a tremendous, a huge proportion of the emissions produced by the US firms. If I were to look at the time series patterns, let us take into consideration of the imports. Here you see that the imports have been increasing in the same direction as the total emissions of US firms. So given these graphs that we produce in our paper, we are trying to argue that US firms tackle climate change not by just simply reducing emissions, direct emissions, but they are outsourcing their emissions to overseas, their suppliers overseas. So this is pretty much what we're trying to establish in this paper. So our research questions are the following. We ask ourselves, how do US firms fight climate change? Do they reduce scope 1, 2, 3 emissions? As we have seen earlier on, is pretty much scope 1 and 2 and not 3. And how they curb scope 1 emissions, whether they do it by outsourcing carbon pollution to overseas suppliers so that it results in a, results in a carbon leakage. And what are the mechanisms that drive firms' behavior? So we also finally look at the implications, the economic consequences, whether they produce green technologies and how, whether investors are aware of behavior and properly price it. All right. I'm going to go quickly over the data sources. We have used at least 15 different databases to conduct this particular task. This particular study. We use the main databases are TrueCost, where we get the emissions data, scope 1, 2, and we only consider upstream scope 3 emissions. We have data from Geneva that provide us the imports and exports data. We are looking at the imports from foreign suppliers, excluding foreign subsidiaries. So there will be subsidiaries will be part of US firms' own emissions, so we have to exclude that. And we use the firm level ESG reputational risk data. And then these are the other sources of data that we use to establish mechanisms as well as the economic consequences of our study. We merged the databases from three, as I said, the three key databases, TrueCost, CompuStat, and Geneva. We have about 76,000 firm country year observations, about 1,600 unique US firms, 210 supplier countries, and the sample period spans between 2006 and 2018. Now, if we have to look at empirical models, we start off with a very linear model, simple. We have scope 3, which is the upstream on the left-hand side, scope 1 on the right-hand side. We have all the usual control variables that used in this literature. We have the total assets, Tobin's Q, leverage, ROA, R&D, as well as sales growth. We have the fixed effects, the fixed effect combination. We have firm plus country plus year, firm plus country year, and firm country and plus year. So here we have two ways of measuring the scopes. We have the scope measure as a log of 1 plus the emissions of the scope 3, and then we have it measure in terms of proportion, i.e. the proportion of scope 3 relative to the total emissions produced by the firm. So with that, the first baseline results are here. What we've seen is that we have the first 3 columns measures the log of scope 3. The 4, 5, 6 measures in terms of the left-hand side, which is the dependent variable, takes the proportion of scope 3. So from the first 3 columns, you see that as scope 1 increases, so does scope 3. If we were to look at the economic significance of 1 standard deviation increase in tons of scope 1 emissions for its mean will lead to an approximately 19% increase in upstream scope 3 emissions, which is quite a bit. Given that the slope coefficient is less than 1, that means the emissions, when you reduce scope 1, you reduce scope 3 less than you reduce scope 1. So this is one of the, what are the results have shown. If I were to look at proportion of scopes, and you see that a negative coefficient of the scope 1 means that there is a huge substitutional effect between scopes 1 and 3, meaning that when scopes 1 increase, the proportion of scope 1 increase, it will have to be done at the expense of the proportion of scope 3 increases in the firm. So then the obvious question you're going to ask is whether this is mechanical or it is outsourcing. So with this, we look at the interaction between emissions, scope 1 and imports. We bring in imports, which is the uniqueness of our study that have not been really done in the literature besides scope 3. So if I were to look at imports, we measure imports in 3 ways, in terms of the volume, in terms of the container, in terms of the number of counts that we are looking at. And then we look at the slope coefficient of scope 1, this triple interaction term. And if this beta SI is negative, the double interaction, sorry, imports will play a mitigating role here. If you were to look at the results here in table 2, table 3 in the paper, you see that again, the results are very significant. They are all negative, which implies that the share of scope 1 falls at the expense of the rising proportion of scope 3. There is a substitutional effect between scope 1 and 3, which is further augmented by the amount of imports the firm has done or import from the other supply countries. Now we have done identification strategies because some of the results may be driven by production cost considerations other than outsourcing carbon emissions. So we implement several exogenous shocks on the US incentives to outsource emissions. We look at a state legislative pressure where we analyze the congressional voting patterns in the climate change related environmental issues in a particular state to capture the domestic legislative pressure on the firms. We also look at a cross-core congressional elections where the close elections are those within 5% of the or less vote share between the winning and the runner-up candidates. So this is as good as randomly assigned. And we also look at a state level stringency as well as the on-site facility inspections by EPA, looking at your firms, so how often they check your firms. These are all random inspections. All these strategies point out to a causal effect between scope 3 and scope 1. So I will not come into this in the interest of time. We have a triple interaction terms and the results pretty much support our hypothesis that the relationship is not just an association, it is a causal effect. We also did causal cross-sectional analysis. We have outsourcing effects are stronger for firms from more polluter industries, for suppliers from countries with very low enforcement of environmental regulations or stringency of environmental regulations. So this results still hold. And next, what we have done is we look at it. This is one of the highlights of our paper is that we look at internal versus external mechanisms that drive the companies to outsource emissions. So the internal, so basically we look at all the various actors of the firm other than the public. We look at the firm itself in terms of their greenness, the CEOs in terms of their greenness, and the directors in terms of the greenness based on the directors' employment in firms in the last 5 years. So what we have found is that the firms that are more green or greener, our CEOs greener and directors greener, they tend to outsource more than those that do not. And with that, we move on to the, sorry, it went up too fast. Now I can't move it up. So we have, this is one problem. All right, so what we have is the external mechanisms. The external mechanism, we look at government customers. We look at corporate customers that are more green. We look at institutional customers who are more environmentally conscious. And in contrast to the internal mechanisms, the external mechanisms tend to prohibit firms from outsourcing their emissions. And then the primary reason is that they are much more concerned about their global reputation as opposed to firms, the internal stakeholders, they are more concerned about their own reputation in the local community. Now, with that, we move on to the next slide, which we see the green innovations and various sources of carbon dioxide emissions. We found that the firms that tend to outsource their emissions, they tend to develop less green technologies, and the green technologies are mainly negative, which means that they are not, so these are consistent with their outsourcing behavior. When they outsource more, they develop less green technologies. We also look at the reputational risk calculated by using the reputational risk beta, and we found that only the import carbon dioxide have a significant impact on the reputational risk of systematic reputational risk of the firm, as well as the scope 3, which means that investors, the general public, are not able to, they're not able to evaluate the extent of the imports as well as scope 3 emissions of a firm. And if I were to look at the pricing of it in the future return here, we see that these are the imported are the ones that have a positive impact on the future returns, which is an implication that the public has not priced in the carbon dioxide produced by the imports of a firm. Now, to conclude, I know I'm running out of time. The US corporations tackle climate change by outsourcing pollutions overseas is pretty much a whack-a-mole game. Firms that outsource emissions to the suppliers are those that are with less green innovations, and such emissions outsourcing is not priced by their investors. And what are the implications? The implications of our strategies to show that when we are determining reducing the carbon footprint, it has to be throughout the whole supply chain and not at the firm level. Divesting polluting business is not the right prescription. It may induce more pollution elsewhere. And last but not least, our recommendation is that this climate change is really a global issue. It is a quest for international cooperation to achieve a global carbon neutrality. Thank you so much. Thank you. I'll give the floor to Nora.
Thank you. Thanks so much, Lillian, and for revealing what is a rather hidden aspect of climate change and the focus on scope 3. Now I'd like to invite Nora Pankratz from UCLA to discuss this paper. Thanks.
Thank you, Kristy. And maybe a quick check. What's my time budget exactly? I want to make sure I don't cut the questions.
So we've got, if you want to allow for questions, if you could make it in 8 minutes, we would welcome
Excellent.
it. I'll give you the
Yeah, then I'll aim for 8 minutes. Thank you very much. Yeah, thank you, Basma, also for inviting me to discuss this paper. I really enjoyed the read. And so this is a great opportunity to talk about it. Let me see. So first, just as a quick overview, I think Lillian did a great job presenting this, but I think really the gist of this paper is, sorry, slides.
Or no? Are you intending to share? I don't see.
Yeah, you cannot see my slides?
Slides?
Okay, let me check. That's strange. I'll just, how does it look now?
There we go. Perfect.
Excellent. Thank you, Kristy. Okay, sorry about that. Okay, so I think the gist of this paper really is in investigating the effects of the pressure on firms that is, of course, currently rising a lot to cut emissions on their strategic behavior and shifting emissions between the scopes. And I thought that was really interesting. And I don't think I have to do very much to emphasize. I think this is, first of all, really timely. So first of all, the UN negotiations are still going on in terms of the need and the ideal scenario to have a global carbon market that will curb a lot of the behavior that we're going to discuss or discussed already also in the other papers in the session. But then also, especially in finance and the private sector, I think it's really interesting because this debate of the importance of the different scopes of emissions, I think that's really rising. So just recently I talked to somebody at Columbia who said, okay, I've been consulting asset managers and they are really focused on scope 1 and 2 because those are very clear in terms of how they are supposed to be managed. I think very clear is probably debatable, but I thought that was interesting. And then also somebody I talked to at a Canadian think tank said that there's just this huge uncertainty for institutional investors of how to go about addressing scope 3 and how to monitor scope 3 emissions in their portfolios, just because those are particularly hard to track. And I think it's really important, and I'm just going to reiterate the quote that Lillian also had on her slides already. I think this is the perfect quote for motivating the paper in a way that really says, okay, if you look at Procter & Gamble, it can look like their ambitions are really strong actually, and they set up valid goals. But then if those ambitions are based on scope 1 and 2 only, and scope 3 is really what makes the difference here, then this is really important for us to understand and to be able to look behind what firms are actually doing and whether these efforts go far enough. So in that sense, I think it's a great paper. And I also really, really enjoyed the idea of the paper, just in terms of the surrounding literature. So just coincidentally, in pulling up my discussion template, I realized the last paper I discussed was the paper by Bartram et al. But then there's also the Ben David paper, and both of them focus really on the outsourcing behavior in terms of scope 1 and 2. So what firms do to shift their production outside of the country or outside of the state in order to escape some of the legal pressure to manage emissions. And so I think this paper is really smart in finding the sort of saying important next question, which is really, okay, so what about the strategic behavior and shifting between the different scopes of emissions within one firm, in addition to considerations about foreign versus domestic production. The data work, I don't have to say much about that. I think is also very impressive, as seen on a long list of sources that Lillian showed. So I think this is really, really neat and also creates a lot of potential in the whole analysis. And then the way this is set up is really neat as well. So we already have these 4 parts that are important to most papers, I would say. So starting off with the reduced form regressions, then going to a large set of instrumented regressions, and then a cross-sectional test, as well as even value implications. So I think the scope of the paper is really far already. Okay, so in the remainder of the 8 minutes, I think I'll try to focus on 3 points. I have 5 on the slides, but let's aim for 3, and maybe I'll even get to less of that. So in terms of the comments, and probably also important to highlight, I think this paper is really fresh off the press, so I may raise some obvious points to say, but maybe those are just pointers in terms of where would be a good point to start. So first of all, I had a short comment about the framing of the paper, and I thought there would be really a low-hanging fruit here in making clearer what exactly we're trying to learn about in this paper. And again, this may also be biased, so to say, by my, or that the other 2 related papers are really salient to me, but I thought it would be fantastic if the paper could make even clearer that 2 things are going on here and 2 things are added to the literature. So I think really the new thing is the shift within the firm, or the strategic behavior of firms to shift emissions from emissions caused by own productions to emissions caused by suppliers, which essentially means that firms, in order to do so, would have to outsource more. But then in bringing this really, really interesting data set on imports into the picture, in a way, the paper takes a similar route as the 2 other related papers, and again, focuses on the specific interest in doing this outsourcing, but also outsourcing not only within the country, but very specifically to suppliers abroad. And so in that, I thought maybe it would be helpful for the reader to make these assumptions even more explicit. So what do investors really care about, and do they really know less about scope 3 emissions within the country? So is that enough? For me, for example, if I'm a US firm, is it enough to just have someone else do part of my production and thereby lower my footprint? Or do I need to pick someone abroad in order to be able to hide these emissions, so to say? And I thought that the paper, at the moment, the paper takes a little bit of a mixed route in that. So again, I also see the appeal of the import data, but I thought it might be helpful to make that really clear. Plus, potentially, there could even be the room, just in terms of all the data that you gathered already, to model these 2 outcomes separately. So to first of all, look at the probability of firms to choose an additional supplier or choose suppliers in the first place instead of doing the production in-house, which would be just a shift from 1 to 3. But then also be able to benchmark that with the probability that I don't only shift to a supplier just outside of my own boundaries of my own firm, so to say, but that I really want to pick a foreign supplier in order to best hide these emissions, so to say, or make them least transparent. Yeah, so I think that would be a really easy point to address, and potentially these tests could be really interesting. Okay, given my promise about the time, I would almost say comment number 3 might be more important than comment number 2. So one thing that I thought that would be great to clarify in the paper would be what's behind the scope 2 and 3 emissions. And what I mean by that is, first of all, whether the scope 2 emissions are substantial or not. I've seen a little bit mixed discussions of that. So I absolutely trust your statement that for your estimates, it does not really make a difference. But again, just for the coherence of the story, I think it could be nice to really group 1 and 2 and then compare that to 3, just because 2 is still part of the own production of the firm. And in a way, I think it would be something that people would want to know about. So this is just a little bit of subjective assessment of if you can get that back into the paper, I think that would be really valuable. But then my main point was motivated by also reading the paper by Patrick Bolton and Marcin Kasperczyk on the investment side of things. So in their paper, they discuss scope 3 emissions and essentially say that scope 3 emissions currently in the true cost data are calculated or imputed, so to say, based on firm level expenditures. And that firm level expenditures are multiplied by industry level indicators of how intense production is supposed to be based on the industry that the firm is operating in. And then again, an input output matrix with different sectors in different countries that this industry would usually be related to. And all of that, of course, brings up the question, okay, so how much do we really learn from this firm level analysis, just in this case here, or the way that the scope 3 emissions are used at the moment? Yeah, and coming to closer to a close here, I would say maybe again, just to the pitch of the first stage, so to say, maybe the paper could even focus more on the questions of, okay, so just first of all, if we see exogenous shocks to the incentives to outsource production and have potentially also these suppliers abroad, maybe first of all, just focus on, okay, do we see that uptake of additional suppliers or different suppliers? And I think that could be just as important as using the scope 3 data as it is used at the moment. Okay, and then last but not least, perhaps I just wanted to bring this one up, so on the exclusion restrictions of the instruments. So again, really, really impressive work on different instruments, different ways to think about where this exogenous shock could come from. And I think overall, it's really nice. The only question that I wanted to raise, and I think that could be discussed more explicitly in the paper, is, so what if the shocks to incentives to cut emissions? So for example, in increased policy pressure, because there are more delegates in a certain state that are interested in environmental topics. To what extent could these incentives also come with other reasons that outsourcing production is more interesting? So for example, if you look at liberal delegates in the US, some of them who are really interested in promoting environmental topics are also, so to say, have strong opinions about labor rights or wages and so on and so forth. And so I was just wondering whether there could be more intentional or more attention in the next version of the paper on potentially coinciding shocks that come out of these instruments. Yeah, okay, but then I think we already made it in terms of, or made it past the deadline. So again, I think overall it's a very promising research idea. I'd love to talk about it a little bit more. Thank you again for the opportunity to read it.
Thank you, Nora. And I'm sure the authors would welcome your slides to be shared with them. We have only 3 minutes, so I'm going to open it up to questions. If there are any, please present yourself. If not, I'm going to move to Lillian for a response. Okay, Lillian, please take it away.
All right, thank you so much, Nora. Those are excellent comments. I think we could, the earlier version, we put scope 1, 2, and 3 separately. Scope 2 had no effect at all. So, but we could always combine scope 1 and 2 to just kind of make sure that we have scope 2 in the regression. I like that idea of looking at probability, engaging another foreign supplier to show that there is an intention to outsource the pollution to overseas, given that the supply will not have to be local, since the local will have the same policies, they will be subject to the same pressure from the local community. And I agree that scope 3 emissions are imputed, and we spoke to S&P Global. They have been trying to refine their computation as much as they can to make it as accurate. I think this is, I'm not sure whether there are other ways to sort of look at scope 3, but we know that scope 3 consists more than 50% of the emissions produced by a firm. Even though Amazon and Microsoft claim that they're going to be, they are actually carbon net neutral, which is not true. Now we're looking at scope 3 that they produce. The cloud that they have will have tons of scope 3 emissions produced by this high-tech company. There's another area that we will be, I personally be interested in looking at. So overall, I think this is great comments. We have many rounds of revisions to do, but we will definitely incorporate your comments and suggestions. And I'm happy to chat with you later. Thank you.
Thanks, Lillian and Nora. And thanks to all of the speakers and discussants during the session this morning. I'd just like to encourage everyone to make use of the break to further the discussion on these papers and perhaps get to the questions and comments we weren't able to because of time constraints, and apologies for the mix-up there. I'm going to hand over to you, Basma, to make any final announcements before we close the session.
No further announcements from me. Cheryl is our expert in creating breakout rooms in case anyone wants to join. You can, I think when you look at breakout rooms, you can see names of people that are assigned randomly, and feel free to switch between rooms if you want to meet specific people.